Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and I'm joined today by Tanguy de Lauzon from Morningstar Investment Management to talk about the FTSE 100. Hello, Tanguy.
Morning, Emma.
So this week marks the 10-year anniversary of the previous FTSE high. Before the following year, we had a significant crash. And I was thinking about during that time and the difference between the sentiment then 10 years ago and the sentiment now. And the sentiment now seems to be this rally is very underloved. People are waiting for the correction to come. But back then, 10 years ago, people were confident. People were liking the stock market and they certainly didn't see the crash coming, did they?
Yeah, no, certainly. I think the situation was a bit different. I think at the time, the economy was doing very well. I think, emerging markets had a brilliant period the previous years. Corporate were generally, having very high earnings. And actually, probably that was a trick. I think corporate were doing so well. The earnings were so high at the time that, when people looked at valuation signals like price-to-earning ratio, it would look okay, actually. But if you looked at other valuation signals, probably like the cyclically adjusted price-earning ratio or price-to-sales or price-to-book, so looking at, rather than looking at the recent earnings, looking at, average cycle earnings, you would have signed that valuations were quite high at the time. But the situation was certainly a bit different.
And you spoke there about some warning signals. Were there other warning signals on the horizon that could have perhaps predicted what was to come, the global financial crisis? Yeah,
I think it's always difficult to predict a crisis, almost by definition. If a crisis occurs, it's because it's unexpected. But you have early warning signals. So valuation were one typical signal that we would look at. I think, market was also quite optimistic, sort of believed in a Goldilocks scenarios where everything happens and everything is going well. I think markets started to become a bit complacent as well about risk, about some of the financial innovations, and that should be things that, one want to consider to assess the environment.
And so what happened next? We had this high 10 years ago this week, but in the next couple of years were very difficult for investors, weren't they?
Yeah, so obviously a big crash in the market. So most equity markets down, roughly by 50% over the next 18 months. Fortunately for UK investors, the pound crashed as well. For those who had foreign exposure, that was helpful. But basically, we had this big series of events culminating with the Lehman failure, obviously. And so it was a very tough period for a lot of investors. But actually, for investors that, remained with a long-term focus, really thought about their investment goals and that those investment goals should always be over the long term. It was actually an okay period because if you consider it three and a half years after the peak, you are back at the same level if you include dividends. And so it's really a tough period for a few years, but for long-term investors, it was actually possible to navigate through those difficult periods and to maintain investments. And 10 years after, we're actually 60% above that level. So, it's close to 5% per annum. So not a fantastic return, but something okay for someone who invested for his pension.
It's always easier said than done with that, though, because as we know through a lot of the behavioural science that we've studied here at Morningstar, when a crash comes, people tend to take their money out. They do panic. So what can we learn from that experience, from the figures that you've just told us, about the fact that the market now is looking similarly overvalued by a number of metrics?
Yeah, so I think there are a few things to be prepared. You need to be prepared for this thing. You can't really, think about what you're going to do as it happens. So I think there are a few things, a few key investment principles that you need to have. And a few of the ones I would highlight is, keeping that long-term horizon in mind, remaining focused on that long-term. That's very important. I think valuation is probably the most useful tool in terms of assessing where we are. Looking at the fundamentals as well, not only to assess what's the most likely scenarios, but what the range of scenarios, and trying to see whether there will be periods where there is an asymmetry in those scenarios, where the chances of positive scenarios are becoming, slimmer, and when actually the chances of a negative scenario, of a negative shock, are becoming larger. And then the last I would highlight is to be independent-minded. In those periods, all the press, all the media is very negative. You talk to your friends and families, they are very negative, and it's very difficult to keep to keep calm, to control your emotions. But if you're able to do that, then you should stick with your investment in those periods. And maybe actually there are some opportunities that are offered to you to buy at very cheap prices stocks that are actually might be quite attractive.
Tanguy, thank you very much.
You're welcome.
This is Emma Wall for Morningstar. Thank you for watching.